If you're watching metals, if you're tracking macro, if you honestly just care about where the financial system might be bending right now, you need to pay attention to this. Because something just happened in silver that you almost never see. Roughly 34%. Gone. In a single session. And while everyone was staring at the price collapse, while the headlines were screaming about the drop, something far more important was unfolding underneath the surface. Positioning data suggests that one of the largest players in the market may have been shifting exposure right into the chaos. Stay with me because I'm going to show you why this moment could be less about panic and more about transition. And if you're watching this right now, you're already ahead of 90% of people who think they understand what just happened. Before I explain what caused this, let me teach you something most investors never fully grasp. Markets don't usually break because fundamentals suddenly change overnight. They don't collapse because some new piece of information appeared at 9 in the morning. They break because positioning becomes fragile. Think of the silver market like a crowded theater with only a few exits. When someone yells fire, it's not the size of the actual threat that creates the stampede. It's the realization that everyone might rush the door at once. That's what happened here. The structure was brittle, and when brittleness meets pressure, things snap fast. Here's what you need to know about futures markets. They're heavily leveraged. That means a small move against you can force liquidation whether you want to sell or not. You don't get to choose. The exchange makes that decision for you through margin calls. And when forced sellers hit thin liquidity, when there aren't enough buyers stepping up at reasonable prices, price doesn't glide lower in some orderly fashion. It falls through the floor. If this is making sense so far, drop a comment and let me know where you're watching from, because I want to know who's paying attention to this stuff. Now here's what's actually happening beneath the headline numbers. Let me break down the sequence, because understanding the order of events is everything. First, prices started sliding. That alone isn't unusual. Markets move. But as silver pushed down into that $75 to $80 zone, leverage began to snap. Margin calls hit. Long holders, and many of them were speculative, were forced to dump contracts. That created air pockets where bids simply disappeared. You know what an air pocket feels like on a plane? That sudden drop? Same thing here. Price fell faster than rational selling would explain because there was no support underneath. Second, and this is the part you really need to understand, delivery and contract movements spiked near the lows. That's the secondary confirmation professionals watch, because when large blocks change hands during disorderly pricing, it often signals that stronger balance sheets are stepping in, while weaker ones are getting flushed out. It's the financial equivalent of watching who's buying property during a foreclosure wave. The timing tells you something about intent. Third, open interest shifted in ways that suggest repositioning, not just panic. If everyone was running for the exit and nobody was coming back, open interest would have collapsed entirely. But that's not what we saw. We saw transfer. And transfer during chaos is very different from abandonment. Here's what's wild about this. Mechanically, a crash is one of the easiest environments for a dominant short player to reduce exposure. If you're massively short, you don't want to buy back contracts in a rising market. That pushes price higher against you. Every contract you cover adds fuel. But during liquidation, sellers are everywhere. You can quietly close risk into the avalanche. Nobody notices you're buying because everyone else is selling harder. But here's the part that should make you pay attention, because this changes everything going forward. If a major short was reduced during this event, the future pressure from paper selling may have just decreased. And if that happens while physical demand remains steady or even tightens, the character of the market can change faster than people expect. You're not looking at the same supply-demand structure anymore. The overhang just got lighter. This is the exact same playbook we've seen before. Let me show you the pattern, because history doesn't repeat, but it absolutely rhymes. Go back to 1980. Silver didn't just drift lower after it spiked to $50. It violently reset as positions unwound across the system. The Hunt brothers' leverage collapsed, forced selling cascaded, and in the aftermath, what happened? The narrative said silver was finished. Demand was supposedly dead. But zoom out and you see something different. You see structural clearing. The weak hands exited, the market rebuilt, and silver didn't disappear. It consolidated for years, then started another cycle. Then look at 2011. Silver hit nearly $50 again. Another dramatic collapse followed, another massive reshuffling of exposure. I remember the headlines. They said the silver trade was over, retail got destroyed, leveraged longs got wiped out. But what actually happened underneath? The same thing. Transfer of risk from weak hands to strong ones. And while silver didn't immediately rocket back, the foundation shifted. Every time this has happened, the immediate narrative sounded like demand was dead. But when you look at what comes after these events, you realize the larger story is rarely, this asset is finished. It's usually, the balance sheet landscape just changed. And new cycles begin after clearing events, not before them. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this interpretation be wrong? Absolutely. Position data is never a confession note. We don't get to see inside the decision-making rooms. And the internet loves to jump straight to manipulation claims anytime a big bank is mentioned. I get it. It feels satisfying to blame someone. Here's the thing. Markets don't need conspiracies to behave mechanically. Leverage plus liquidity explains most extreme moves. You don't need some secret cabal in a dark room. You just need too many people holding the same position with borrowed money in a market that can't absorb sudden selling. That's it. Physics takes over from there. Could this just be the beginning of a longer collapse? Yes. Could physical demand actually be weakening and we're seeing the early signs? Possible. Could macro conditions deteriorate and take silver down with everything else? Sure. All of those are on the table. But here's what I'm focused on. The mechanics, the structure, the evidence we can actually observe. Because speculation about motives is endless, but watching what's measurable keeps you grounded. So focus on what you can control. Watch positioning. Watch liquidity. Watch who survives the volatility and who doesn't. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. Some of you are long silver, and your stomach dropped during that candle. Maybe you bought in the 90s or higher. Maybe you've been stacking physical for years, and you're wondering if this invalidates the thesis. Totally understandable. Volatility feels personal when your capital is attached. When you see 34% vanish in hours, it shakes you. But your job isn't to react emotionally. Your job is to ask whether the structural thesis has changed or whether this was forced selling. Did the fundamentals of supply and demand shift overnight? Did industrial usage collapse? Did central banks suddenly become hawkish forever? Or did leverage unwind in a thin market? Those are very different scenarios. One changes your thesis, the other tests your conviction. Others of you are on the sidelines thinking, is this the break I've been waiting for? Is this my entry? I get it. Sharp declines feel like opportunity, and maybe they are. But patience matters here. Sharp declines often come with aftershocks. The first bounce isn't always the bottom. Strong markets rebuild before they trend. So if you're looking to enter, watch how it behaves in the days and weeks ahead. Does it hold support? Does buying come back in? Or does it keep bleeding? Let the dust settle. You don't get bonus points for catching the exact low. And then there are the pattern watchers. The ones asking, what is this teaching me for the next crisis? What can I learn about market structure? If that's you, you're my people. Remember this. When leverage unwinds and liquidity disappears, price overshoots both directions. Always. Markets are not perfectly efficient machines. They're emotional, mechanical systems driven by flows and forced decisions. The faster you accept that, the better you'll navigate these moments. So here's what I want you to answer in the comments. Which type are you? Are you holding and rattled, waiting to enter, or just studying the pattern? Let me know because I'm curious who's in this community. Here's where I stand. I'm not treating this like random panic. I think this was mechanical, possibly structural, but not meaningless. Let me tell you what I'm personally watching going forward, because this is how I'm approaching the next phase. First, I'm watching follow-through and positioning data. If we see continued reduction in concentrated short positions over the next few reports, that tells me the overhang theory has weight. If shorts rebuild immediately, that's a different signal. Either way, the data will tell us whether this was a one-time clear or just volatility. Second, I'm watching physical supply signals. Premiums on coins and bars, inventories at major dealers, delivery demand on the futures exchanges. If premiums spike while paper price stays subdued, that's a divergence worth noting. It means the paper market and physical market are telling different stories. Third, I'm monitoring whether rallies start failing or accelerating. If silver tries to bounce and gets rejected hard at resistance, that suggests sellers are still in control. But if it reclaims levels quickly and holds them, that suggests the clearing worked and buyers have confidence. Based on my analysis, this event was mechanical, possibly structural, not just noise. The fundamental picture around silver hasn't evaporated overnight. Global debt is still elevated. Central banks are still holding massive balance sheets. Industrial demand for silver in solar, electronics, and green technology hasn't disappeared. The supply side is still constrained, with declining ore grades and limited new discoveries. None of that changed because of one day's price action. What changed was who's holding the risk and at what price. If history rhymes and silver consolidates after this flush, the move that follows could be significant. I'm not making a price prediction. I'm saying the pattern suggests that violent resets often precede new legs, not endings. That's what the historical record shows. That's what market mechanics suggest. Whether it plays out that way this time, we'll see. But I'm not betting against the pattern until the data tells me otherwise. I'm not a financial advisor. This is not financial advice. Do your own research. Make your own decisions. I'm sharing my analysis and what I'm watching. You need to decide what makes sense for your situation. If you made it this far, you're the kind of person who thinks critically instead of just reacting. That mentality will serve you well, not just in this trade, but in every market you ever touch. Because markets reward people who can stay calm and analyze structure when everyone else is panicking or celebrating. If this breakdown helped you see the situation differently, share it with someone who needs to understand what's actually happening beneath the headlines. Subscribe if you want more analysis like this when the next structural event hits, because I promise you, there will be more. And leave a comment with your biggest takeaway, because I read every single one. This crash wasn't emotional noise. It was a stress event. The fundamentals didn't evaporate overnight. If anything, the system may have just redistributed risk. And if history rhymes, moments like this don't end stories. They begin the next chapter. Stay sharp out there. Think critically. Verify what you hear. And make your own decisions.